Hello and welcome to the next episode of Smart Humans. I am super excited about today's guest. I've known him for well over a decade, but only more recently got to collaborate with him. Many of you listeners will already know him as he's a media influencer out there and a super angel. Jason Calacanis, welcome to the show.
Thanks for having me.
Absolutely. Well, we always start in the same place, which is asking, how did you even get into alternative investments at all?
Well, I was a journalist and then an entrepreneur in the technology industry. And after hosting a bunch of conferences where people launched products, the first of which was in 1995, if you can believe it, it was called Ready, Set, Pitch in New York. Ted Leonsis from AOL was there, and we had people pitch 5 ideas. Ever since that time, people said, wow, you're good at picking companies. And as a journalist and putting people on the cover of Silicon Valley Reporter magazine or doing Engadget, Autoblog, Joystick, we just had a good editorial sense of which companies to focus on. Well, the job of a journalist, very similar to the job of an investor. You're meeting a bunch of people trying to figure out who's going to change the world, who's the most interesting, who's not full of BS. And sure enough, it turned out Sequoia Capital, a venture capital firm here in Silicon Valley, asked me to be a scout for them. And the scout was a new concept. We'll give you some money. You invest it. We'll split the returns 50-50. And so I started doing that with Sequoia, hit a bunch of hits like Uber, Thumbtack, DataStax, great companies. Then I started some small funds, and I now have a 21-person investment company that does a bunch of podcasts you may have heard of, like This Week in Startups and All In, and conferences. And then we have an investment team, and we invest about $100 million a year now in startups in the early stage.
Amazing. What year was that Sequoia effort that you were working with them as a
I
scout?
guess 2009. It started right at the tail end of the Great Recession, which is paradoxical considering we're probably in a recession right now.
Yeah, we'll want to talk about the market and how that influences. Sounds like that was the springboard for you. Is that right?
Well, I always tell people like fortunes are made in the down market; they're collected in the up market. So the best time to be investing is in a down market. People know the famous quotes about blood in the streets and investing when people are scared, and being scared when everybody is greedy. So, when you're investing in a down market, there are less people starting companies and less people investing in them. This means you can take your time, get to know companies, make a really thoughtful investment, not out of fear or FOMO, but out of, really doing your research. And then the people who are active during down markets tend to be the most resilient, the strongest, the crocodiles, the sharks, the cockroaches, the people who don't die. In a down market, a lot of the people who are playing the part of founder or investor, but who aren't really committed to those roles and they don't do them for a living, they tend to go away. So it's been tourist season in Silicon Valley and startup land for 5-6 years. And I've seen this movie before. The tourists come in. Oh my God, I want to live here. This is the greatest life I could ever imagine. And then, they eventually go home. And so they're all heading home now. Some of them licking their wounds. And it's just back to work for the people who do this for a living professionally. And so I kind of
Tourist
enjoy the
season.
down market. Yeah.
No, that's a good line. Tourist season. I'm gonna have to remember that one. So you obviously know a lot about startups, angel investing, venture, etc. How much do you know? How much do you participate in the other segments of alternatives? For example, real estate, debt, collectibles, art, or crypto. Feel free to pick any.
Yeah, we made a good trade with crypto, buying Bitcoin when it was like $100. So, we did well there. But I'm not active in crypto. I'm really active in startups because I like to evaluate the product as well as the team and talk to customers. And in crypto, you typically have a team and you don't have a product. You may have a white paper, an idea of what they want the product to be, maybe some basic bones or some rails of the product that they forked. But it's very rare that you're investing in a crypto project when they have customers. In fact, most of the products, if you look at them, outside of money transfer, speculation, and store of wealth, you don't really see a lot of products out there yet. And the products you do see are, really clunky and nascent. So it's not for me. I have access to the greatest asset class available, which is startups. And so I try to focus on those. I am crypto curious and, I keep my finger on the pulse of it and I have a handful of investments, but It's just not for me because I'm a product person. So I like to look at the product and talk to the customers, and that's just not possible in 99 out of 100 crypto investments. I do have some collectible cars. I have the 16th Roadster ever made by Tesla, and I
Nice.
just got offered to put that on Rally Road for $250,000, and other people are buying them for 250K. Those early ones, the first 100, which were called the Signature Series. And then I have the first Model S ever made, called the first Signature ever made. There were a series of Founder Series and prototypes made before the public, so I have Signature number one of that, and I guess that's worth $1 million. So I have two collectible cars, and I love that. And I would invest in more. I have bought paintings on Masterworks and have bought into companies on Republic, Seed Invest, and Our Crowd. I think those platforms do a solid job. All four of those, in fact, I think do a real good job of curating. And that's really what I look for in those alternative platforms. I have a Basquiat I own a piece of from Masterworks as an example. And
The
I
Basquiat, you have fractional ownership or
a
a whole
fractional
owner?
ownership. Yeah, I don't own
Yeah.
an actual real Basquiat. I wouldn't want to own. I mean, I could afford to probably buy like a modest painting, maybe in that range, but a 6 or low 7 figure painting. But I wouldn't know what to buy. I don't have an advantage there. I'd be too weighted in one investment. So, like the people who angel invest with me at the syndicate.com, the average investor is putting in $7,000, and there's an average of 100, 150 of them per deal. So, you know, I like the idea of making a lot of small bets, learning about different asset classes, and then when I have an affinity for them and dexterity or some inside line, maybe doubling or tripling down on the things I have some good firsthand knowledge or some conviction on. And really, startups is the bulk of that. And real estate, I own 3 properties, including my primary residence, and I buy those basically for utility and enjoyment primarily, and secondarily as a hedge against how deep I am in tech. So, I mean, unfortunately, they are also in the Bay Area and Tahoe, so that and San Francisco. So those properties are tied to tech, I guess, arguably. But I like real estate because you can use it. I think that's pretty great. But I don't speculate on real estate at the current moment for like an Airbnb or through REITs or anything like that. But I'm curious about those, and I might do more. I was particularly curious about the fractional ownership of homes like Picasso does and some other platforms are doing. I wouldn't mind doing that with some friends, like creating an LLC and having 10 friends buy, an estate in Tuscany or something, and then splitting the cost, and then having a management company run it for profit, and then us getting, whatever, 2 weeks each, a year or something. Or
Do you think you would do that on your own with your friends, or you think you would go through one of those platforms that you just mentioned?
I would have to do the math on it. If you did it with your friends, obviously that can get complicated. But I do have a couple of friends who have shared a plane before, like a Pilatus, like these little regional planes, and they're not expensive and they're easy to operate. So they're perfect for like, going from San Francisco to Truckee to Vegas to San Diego, LA, that kind of route, the Pilatus PC-12. So I have a group of friends who share one of those, but they don't do it through, like NetJets. They just did it themselves. They created an
Sure.
LLC. And so, yeah, it seems like this is fractional ownership of assets are going to be a thing. I wouldn't want to have to do the work. So I guess that's where using a Picasso, or I'm sure somebody will come up with a white labeled version of Picasso, or you could use an attorney to do it, I guess. But who's going to
Absolutely.
manage cleaning it, maintaining it, and then the scheduling issues? I think those are the big 3 things that those platforms manage for
Uh,
you. Yeah.
it sounds like a majority of your alts are really more about appreciation, more speculative, as opposed to yield orienting. How do you think at all, if more than zero, about trying to get some sort of yield out of your alternatives and getting income generation, or is that not something you think about?
I live in this very, I'm lucky to have this very bursty, pursuit I do of angel investing. And so when something hits, every couple of years, something big hits. And so that's really nice. And then I have the consistent revenue of my media business, This Week in Startups, that does well. So I have not looked at the investments for distributions because I have those 2 steady state revenue opportunities already dialed in. And I did have an Airbnb we were running for a little bit. Our previous home in our neighborhood we kept for a year, and we did the Airbnb. It was a little bit too much to manage personally. If I and people wanted the house, so I just sold it. And I didn't want to be the guy in the neighborhood. We live in a fancy neighborhood. I didn't want to be the guy in the neighborhood running an Airbnb because one night somebody threw a party in it, and I got them, and they did $5,000-6,000 worth of damage, which Airbnb took care of, and their insurance, and they billed the person for throwing a party. But like just basically for the neighborhood, which is a small number of homes, having somebody throw a party and your neighbors calling the local police department is not fun. So I didn't want to be that guy. And it seems like, getting people to not throw parties, even though I had cameras up in the place, and it's like, we told them and they signed the agreement, like no parties. And then 40 people show up and they share it on Instagram, and another 20 people show up. And it was like, literally, I'm getting these like Nest Cam alerts, like somebody's in the driveway, somebody's in the driveway, somebody's in the driveway. I wake up, my phone is like 50 alerts. It's like, why are people in the driveway from midnight till 5 a.m.? Like, it's a pretty good fucking party. Sorry, pretty good freaking party. So yeah, the police were not happy.
So when you buy like the Tesla Roadster or the model signature number one, if I'm saying it correctly, are you buying it thinking that, oh, this is going to be worth a lot one day? Or is it, this is just awesome, I want to own one of these because it's interesting? Or, my buddy is doing the company or running it.
Yeah, it was
so
because I'm friends with the founder. But in that case, I kept them. I could have sold them early on. And a lot of people I know who did have early versions did sell them. But I did understand having number 16 and number 1 was very significant. If the company thrived or if the company didn't make it. And let's face it, the company didn't, almost went out of business 2 or 3 times. So either way, those cars are super valuable, and they'll be more valuable in 10 years than they are now. So they'll probably be worth, low millions each in the coming years, I would think, in the next decade. So,
and are you thinking that you're going to hold it, quote unquote, forever and pass it to your kids? Or do you have some sort of number in mind when you want to sell the signature number 1?
It really is, for the real issue is having garage space for them. It's like super pragmatic, and also having to, have the custodianship of these. So like what I like about, the little piece of Basquiat that I own from Masterworks is I don't have to deal with it. They deal with it. They store it. So I might give Rally Road the Roadster, the 16 Roadster, just so it sits somewhere and somebody's maintaining it and making sure it's plugged in and all that kind of good stuff. And then I get one of my parking spaces back. But the Model S number 1 is just such a collector's item. I might keep it till I'm 70 or something.
Yeah, they both sound amazing, but that sounds like it's super special.
It's kind of super special. I'm trying to feel how emotionally I would feel if I were to sell these and then somebody else were to sell them for a lot more in 10 years or 20 years, like the idiot insurance. That's one of the nice things about Rally Road is they said I could sell half of it. So if it was, it's worth 250K. So if I sold half of it, I get 125K right now. I paid 150 for it. I'm not sure how that works on the tax basis. I have to understand that, but I would be able to recoup some of my original investment while still owning half of it. So if it did become worth 2.5 million, right, and they sold it, or if they chose to sell it in 5 years and it doubled in value, I would get another 250. So I would still be in the game, right?
Sure.
Which I think is why some of these platforms are going to do particularly well. With the Picasso example, the home I bought, my ski house, Picasso wanted to buy it, wanted to, with the original owner, give them like 2 shares and sell 6 shares, or take half of it and sell half of it. They wanted to do that with me possibly. And I didn't want to have to fight to get ski week and, Christmas with the new buyers and be in a lottery for it. I bought it specifically for those moments in time. So, but eventually, when my kids are grown, maybe I'll put in the Picasso pool and keep 1/8 of it. Yeah, it's possible. I think it's an interesting way to liquidate assets while still maintaining some ownership in them. If you owned a Picasso and you gave it to Masterworks, I suppose they could sell shares in it and you could keep 10% of it or 20% of it. I don't know if they do that, but that's actually a really interesting thing about this alternative asset class, is that for people who have an affinity or a love for what they own, they can, keep some equity in and keep some skin in the game.
Yeah, I would totally agree with you. I think actually the most expensive car just sold recently, like a Ferrari for, I think from the 50s for about like $140 million. So there's definitely some upside.
Isn't that crazy to even think about? $140 million? That's like you could buy a jet.
Yeah, yeah. And then a
And
Warhol just sold for 195 as a painting. Both,
I mean, it's like,
setting the
I just
records.
think about that and I think about other assets. You could buy the most expensive private jet, a Global 7500 or 7000, whatever that is, for 70 million. You could operate it for years for 10 million for your pilots and fuel, or 20 million, that's 90 million. And then you could buy $10 million homes around the world, or whatever, $15 million homes, and staff them. And it would be the same as that painting. So it is really
The
amazing.
people love their rare assets. Having what
Exactly. I
other
mean, this
people
is
don't have is special. Like you have that signature number one.
exactly. Well, when you think about it, you'd say, well, why would anybody do that if they could have either or? Well, it's like they already have that. They already have the plane, and
Right.
whoever bought that for 195 million, they're like, but I already have a plane and I already have 10 homes. So why would I do that? Like, I've already got those things. I've experienced that. I want to experience owning this.
So transitioning to the market overall, without picking a specific vertical, just really getting the hot takes from Jason. What do you think of the market today? And take it wherever you'd like.
Hmm. So market obviously got overheated. We had a ton of stimulus. We talk about this a lot on This Week in Startups and the All In podcast. And market got overheated. We printed too much money. COVID created a bunch of indigestion in the system and a lot of weird things that all occurred in a very fast fashion. We're talking about like a 30-month period here where people didn't leave their homes and had money dropped on their heads, like unemployment, extra unemployment, stimulus, PPP, if people forget that, like companies got 6 months of revenue, if they didn't fire people. So there was just money dropping from the sky. What did that do? Well, a balance sheet has, revenue and your costs. Well, they got all this money coming in, stimmy checks, et cetera, and they didn't spend any money because they were stuck at home. So there was no going to the movies with your family and buying a bunch of popcorn and parking and all that stuff. There was no Disneyland trip. Disneyland was shut down. There's no going to a Warriors game because they were playing in the bubble, if people remember that. So people had these record massive, cash balances, on average. Now, of course, there are people who are suffering and people died, but just looking at it economically, we printed far too much money. And thank God we didn't do that last couple of $1 trillion in stimulus. But low interest rates and a massive amount of spending set us up for assets to become overvalued. Peloton, whatever, we were trying to figure out if Peloton was worth it. And I was like, they're getting 30,000. I think if you just, at one point I did it and it was like $30,000 per subscriber. And I was like, well, they'll never make that back. So we're betting that they're going to have, 10 times as many subscribers, which might not be a bad bet, but we were giving people a lot of credit in startup land and in public markets for work not done, right? We were valuing companies for executing perfectly for the next 5 years. And so I sat out a lot of deals because I couldn't justify paying $50 million for a startup that wasn't launched, or $25 million for one that had, $500K in revenue. So, and you and I talked about this when you were raising money for Vincent. And so, you have to be disciplined as an investor. You have to think about entry price. Entry price does matter. So people were looking at, these crazy outcomes. I was lucky enough to be part of the Uber outcome. But people were looking at the Coinbase outcome, which has since gone down, 80 and 90%, or the Peloton outcome. And, if you didn't get to liquidate your shares at the peak and time it perfectly, you maybe didn't do so well. So long story short, the pandemic and all the stimulus created a very weird environment. So then we have this hyperinflation. Nobody's ever seen anything like it. Then you have Ukraine and the supply chain issues, China on lockdown. You start putting all these macro events together and you get crazy inflation at a time when we also have a record number of jobs and a record low unemployment. So when you talk to people who claim to understand what's going on here, recessions are based on people not having jobs. Well, we still, even though we started the layoff train now, people still have multiple offers coming out of their layoff. We still have over 10 million jobs open. We still have record low unemployment. So this is going to take a weird series of quarters where we're going to see, inflation going up, layoffs happening, but the number of job openings still being high, record low unemployment, but asset prices getting crushed, speculative ones like Bitcoin or speculative ones like some SPACs. Some of the SPACs were highly speculative. Some of them were actually real companies. The market and individuals are just going to have to rebalance and reprice everything. And so it's like the great repricing and the great reapplication of people going to work. And I think the silver lining is there's a lot of bad projects out there, whether it's crypto or startups. There are weak companies. There are individuals who are weak and not working and should get jobs and should, be productive in society. So when you have these recessions, and I've lived through two really, intense ones, Great Recession and dot-com as a professional, it tends to make everybody focused on what matters, and it tends to be super healthy. So this is a great flush that's happening. A lot of stuff's going to get flushed out, and what will be left will be the strong companies and the strong individuals, and the talent dispersion that's resulted in a lot of average projects. You know how hard it is to hire people. Instead of people having 10 offers, a mediocre person having 10 offers, you're going to have a great person with 2 and a mediocre person with none. And instead of having to sit there and negotiate a pay package that you as a CEO or a founder are like, this doesn't make much sense, you're going to be able to say, hey, this doesn't make much sense. And, what do you think about this package? This would make sense to us. And then people were like, you know what? I don't have anything else going on. So yes, I'll do it. That's what it was like after the dot-com bust and after the Great Recession is people were like, I have nothing else going on. Sure, I'll work at your startup. And when that happens, great magic happens. People are like, I might be able to get a good job at IBM or GE or Google, but they're on hiring freeze. That might be a crummy job. Yeah, I'll take a flyer on a startup. And I'm super talented, by the way, and I'm ready to go. So that's the thing I'm excited about. I'm probably going to invest more in startups in the next year or two than I did the previous 2 years because I was kind of taking a pause on investing in overpriced startups. Well, I definitely took a pause on overpriced startups, and I was being very strategic in ones that are, let's just say, aggressively priced.
So you've implied a couple times that pricing has come in. Can you give some perspective? Are we talking 5% in, 50% in? Are we talking across the rounds? Is it only seed money? Is it the pre-IPO? Where and how much?
Late stage companies are cut in half. So, what would have been $1 billion valuation is 500 million. So if somebody was getting 100 times revenue for a SaaS company or 200 times revenue, so they hit 10 million and people said this is worth $1 billion, or they hit 20 million, the person is worth, $1.5 billion or whatever, that's over. So that got cut in half. People might say it's worth 30, 40, 50 times, revenue, top line in a SaaS company. And then in private markets, people were raising at 25 to 50 million without a launched product. That's over. And then those companies are now, if they did raise and they had, 10,000 a year in revenue, or they just launched their product, had no revenue, and they were worth 50 million. Yeah, hopefully they have enough money to work for 3 years to get to 5 to 10 million in revenue so that they can be 10 times revenue, right? Or 20 times revenue, something like that to be more realistic. So that's where you're going to see a lot of pain and suffering. At the early stage, we used to invest in companies for 5 million, was like a standard seed stage. Then it went up to 15 to 20, and now it's coming back down to 6 to 12. So it'll be normal again. The idea that like a bunch of dentists and whatever go to a Y Combinator demo day, they place 25K bets, after seeing a 2-minute presentation and a high pressure, like the rounds closing FOMO, that's over. The FOMO hard driving startup investing has stopped. The people who I was talking to 6 months ago who didn't close market are now coming back with valuations that are much more realistic, plans and growth plans that are more realistic. And I don't want to say humility, but more realistic expectations of what it's going to take to build value. There's been a lot of entitlement, but across the board, employees have become entitled. VCs have become entitled. Public market investors, crypto investors, and founders. Everybody got entitled. Everybody thought this was easy. It's never been easy. And, the people who were like Coinbase investors were like, I'm the greatest venture fund ever. I'm the greatest investor ever. Listen, I know that with the Uber investment, like you can get, a lot of adulation for, making some great investment. But you also have to be able to capitalize on that investment. You have to be able to realize it. And a lot of people were locked up in a lot of these investments. They never realized it. And so, there's a lot of lessons here. I was always selling, on the way up as an angel investor. If I get an opportunity to sell, if I'm investing at 5 or 10 million, and an opportunity to sell in secondary comes along at 250 million, 500 million, a billion, you can be sure I'm going to take that, or at least consider it deeply, and sell 10%, at 250, 10% at 500, 10% at a billion. Will I look stupid if it goes to 10 billion? Maybe, but I got to redeploy that money in more startups. I
Right now,
could
you're
also
playing
go
with
in.
house money.
Exactly. A little downside protection never hurt anybody. I mean, if you lost 90% of your Peloton investment, 95% of your Peloton investment, your Coinbase, 90% of your Coinbase investment, whatever it is, not picking on any particular company, but the valuations got too high. They're probably too low now. But let's just say you lost 90 cents on the dollar. Well, if you had sold 20% of your investment, you would not be down 90% right now. You
Right.
have that 20% as a flaw, and you'd still be at 30% or whatever, or so of your, peak investment. So it really is important to have some downside protection and lock in a win. And a lot of people don't do that.
Now that you've gone through those other down cycles, recessions, bear markets, etc., what do you tell yourself, or what do you tell somebody who hasn't gone through those things as to how to navigate this as an investor?
I think having a great process and a strategy and a plan is very important. So process, I meet with a lot of companies. Discipline, we like to invest in a certain Goldilocks window, not too cold, not too hot. So that's our strategy. And then we have a second strategy of when they're a winner and they break out and they're growing 3 or 4x year over year, to invest more until we get to about a 15% ownership position. And so if we're consistent with that, and we do our job in meeting a lot of companies, investing in the ones executing at the highest level, and then quadrupling down on our investment, starting with the 3, 4, 5, 6% investment size. And, and there might be exceptions to that. When we find an amazing founder, we might want to go right to 10%. But if you start with a 5% investment, and then the valuation goes up and the revenue triples and the valuation triples, and then you go to 10% ownership, and then it doubles again, and you go to 15% ownership, you probably, have optimized pretty well. Now, it would have been better to buy all those shares at the lowest valuation, but you wouldn't have known if they were going to make it. So I really have fallen in love with, over my 11, 12 years as an angel investor, the milestone-based process we have here in Silicon Valley. You don't need to buy all the shares in the seed round. You just need to be a great partner to the founder. If we're good founders to you and you do another round and I ask you, hey, listen, I'd like to put a little more money in, chances are you're going to let me. And I probably have, if you at least do your documents well and you come to reasonable agreements with your partners, you'll have pro rata or even super pro rata, depending on what kind of agreement you can come to. So I think I really am obsessed with the process, because you can't determine the market. You can't predict the outcome. So what is in your control? And that's really what I focus on. So how many companies, how many people, apply for us, and reach out to us to get an investment from us? How many do we meet with? How many do we sort? How many do we meet with? How many take second meetings with? How many do we follow up with? How many bets do we place? How many bets do we double down on? And how many bets do we double down on again? And then how many opportunities do we have to liquidate those shares ultimately, right? And get a return for ourselves and our investors.
What was that Goldilocks window you're referring to?
So, a lot of folks do not have a strategy of where they want to invest. They just fall in love with the founder who's charismatic. And if the team's charismatic and it seems like a really good story, the narrative works, they kind of get taken by the narrative and the performance of the founder. And narrative is important, right? Like telling a story about, hey, alternative assets are going to play a role in the world, and we think we're good at that, and we're going to create opportunities for people to invest in. It's a great story. I fell for it, right? I was like, oh yeah, I'm taken by that story. But I also need to see execution, right? And I need to invest in a certain window. So too cold for me is you have an idea, you've got passion, and you've got a white paper. Too hot is you're at 20 million in revenue and a $200 million valuation, and you're selling 1% of the company, and you have 0.25% available to me. Like, I'm not really going to be able to build a position there. So what's just right? Okay, you've got your product launched. You're at 250K in revenue, 20K a month, 30K a month. Last month, I times it by 12. We come to a reasonable valuation multiple on that, and we get to buy 5% with the understanding we're trying to build a 15% ownership position. So in future rounds, we're definitely taking our pro rata. And if things are going well, we're likely to ask for super pro rata. So if we have that discussion with folks, If it goes sideways, are we going to want super pro rata? No. Will we take our pro rata? Probably. If it's going poorly, will we do bridges and take pro rata? Probably not. Your job as the founder to make sure this thing is growing if you want to get additional funding from us. But if you are growing, we're going to want to put more money in. And that's just straight up portfolio management. So that's the Goldilocks zone for us, and the valuation matters. So, people who want to have a $10 million valuation and do a pre-seed round, which I don't even know what that means. Like I think that's friends and family or sweat equity, where you actually you put skin in the game. It's like, I want you to put skin in the game. We haven't made anything yet. You're going to give me the money to quit my job. I'm like, I think you save money and then you quit your job. Or you get friends and family, you quit your job, or you build on the weekends and then you quit your job. Like, it's not my job to give you the $250K to quit your job and hire a dev shop and, for you to go to some conferences or crypto parties. I think that's in the entitlement level. I'd rather see people just work, as a consultant 3 days a week and do their side project 4 days a week, work 7 days a week, and get the product to 10K a month in revenue or launched, and then raise a proper seed round. It's better for them to not dilute. So a lot of people wanted to skip steps on both sides, by the way. There were investors who wanted to skip steps. They didn't want to do diligence. They didn't want to talk to customers. They didn't want to have to go build a network and a podcast or whatever, or do meetings. They just wanted to look at whatever Sequoia did in the last round, or Kraft did, or Chamath did, and then dump, $20 million on the head of that company. Like someone like the Tigers were coming in. I didn't have too much exposure to all of them, but these hedge funds or public market investors dipping down into private is always, challenging, especially if they're not doing the work. And my understanding is in all cases they were relying on other people's reputations for investing in these companies, maybe not doing a really good enough job with diligence.
Your consulting story is actually what I lived, which is, when building Indiegogo, I was a consultant during the day and at night, helping to create Indiegogo. So I hear you.
Back to the future.
Exactly.
I mean, that's what the next couple of years will be like. And then you know what that does? It sorts the founders. If you meet a founder and they're doing that, this is a tough founder. They're
Absolutely.
not going to give up. And if the founder needs you to give them the $250K and they want to go to parties in Tulum and expense them and pay for their apartment and go crazy and they don't have any revenue. It's like, okay, that tells us everything we need to know. It's probably not an investment for me.
So
you've invested serious people, serious company builders is
right.
What I've learned is if you're not serious about it, this isn't like a hobby, it's a vocation, you have to really be into it.
Off the top of your head, how many companies do you think you've invested in?
Well over 300 now.
So you've invested in over 300, lots of amazing hits, Uber, Robinhood, and others. Now that you have all this data, what can you share, with the listener to just give them the cliff notes to, have lived your last 20 years, to not make the mistakes and have got the learnings that you have? What does a unicorn founder or company look like at that early stage? And can you tell?
Yeah. So the truth is, you're not in all likelihood going to be able to tell. You might have some survivorship or confirmation bias afterwards where you think you can tell. So since that's the case, you really need to get to 20 or 30 bets. You need to monitor those bets. You need to get to know those companies. You need to get updates for those companies and look for signals that they're breaking out. The signals will be undeniable. They've got a lot of hiring recs. Their revenue is going up double digits per month. Under 10%, they're probably meandering and doing okay. Negative growth, obviously, that's not a good sign. But if they're over 10% month over month growth, that means they're doubling every 7.2 months. If they're tripling every year in revenue, kind of undeniable. When you see those, almost, at least my philosophy is to double click and, take a deep look at why that's happening. And if you don't even have the time, if it's me and I'm doing portfolio construction, I'm probably going to make the bet. So, and you want to look at product velocity. Companies are really about three things: the team that builds a product and the customers who consume that product. And if you get that flywheel going and you're thoughtful about each step along the way, it'll work out fine in all likelihood. What happens is people get focused on things that are not those three things. So they're not hiring better and better people. They're not doing professional development and training. They're not executing in terms of the product, having new updates and regular cadence, and they're not talking to their customers or delighting their customers. So you got to really delight those customers. You really got to build a great product to delight customers, and to build a great product that delights customers, you really need to have a good team. It really is like at its essence, those three things. People will get distracted by, their total addressable market, their competitors, culture. There's a lot of things that people can get derailed by. And so what I've learned is to focus on those three signals. And, if the person's product is not being updated while you're talking to them during the investment period, like they should be pushing a new release every 2 weeks if it's software. And so, hey, when was the last update? Can you share with me the release notes? Like if you've got a software company, you've got a platform, you have release notes, right? And you could pull them up right now if I asked you to. If you want to see inside.com, we did a equity crowdfunding on Republic recently and raised, I think, $700K from our users mainly. And I love this equity crowdfunding. And, I could raise from venture capitalists, but I like equity crowdfunding because it gets your users involved. It kind of forces me to be super disciplined, right? Like I like the discipline that having $100 investors puts on me. I feel really serious about it. Like venture investors who can afford to lose the money have a portfolio strategy, great. But man, if I had, a million, if I had 100,000 people put $100 in, I would take that, like I wouldn't be able to sleep at night. And then if a VC who's got $1 billion fund puts 10 million into your company and they lose it, who cares? Like it's not even 1% of the, what is it? Is it 1% of the fund? Yeah, it's 1%.
How many investors did come into that round?
A couple of hundred. Yeah, it's typically a couple of hundred. Yeah. So
nice.
But I love that stuff. And I did seed invest before that, and that was really great.
And you're big into crowdfunding as it is because in addition to launch your fund, you also have the syndicate, right? So you want to tell the audience about that?
We were the first, I was the first syndicate on AngelList, actually. A little known fact, first scout for Sequoia, first syndicate on AngelList. And now I went and got the domain name, thesyndicate.com. I worked with the company that powered AngelList in the early days called Assure Fund Management. They did all those SPVs and whatnot, and I'm an investor in that company. In fact, and we've done over 250 of these SPVs. I don't think anybody in the startup space has come close to that. My friend Zach Colias, I think, has done 125 or 150. So actually, he's probably number two. Our first deal was Calm.com. It's still our best deal. We invested $376,000 at a $4 or $5 million valuation. The company's worth over $2 billion. It's a very large position for us, a 9-figure position, I guess. We've been actually able to sell some of those shares over time to give some, incredible returns to those investors and still have the majority of our shares. So it's been pretty great. And I love syndicates because I send them a note. Hey, here is why I'm investing in the company. Here's the deal memo. We did our diligence. Do you want to invest? Here's a webinar where you can talk to the founders. You went through this process. So you know how thorough we are. And we take
just to clarify for folks, you are a big investor into Vincent, which is the platform which brings forward this podcast.
Right. So, the syndicate also, I think, makes me a better investor because I have to write that deal memo. I don't have to write a deal memo if I'm investing, but if I'm going to, share the deal with the syndicate members, I think there's 11, 12,000 of them now. And I want it to, I want it to be good. I don't want there to be a spelling error. I don't want if there's a logic that doesn't make sense and you're sending it to all those accredited investors, who many of which are more successful than me, or equally successful or smarter, certainly, they are going to tell me when I'm wrong, and they're going to take a deal memo from 2 years ago and tell me I'm wrong. So it's like being in the NBA on the big stage. Like if I turn the ball over, they're like, remember when you turned the ball over 3 times? It's like, yeah, I do. Yeah, it was a bad game. Like it makes your performance go up when you're on the big stage. And I like that. I like being on the big stage. I like being the number one syndicate. I like that people are waiting to dunk on me and seeing if they can beat me. And so it just makes me more attuned to what a winning company is. And so I'm not as freewheeling, loosey-goosey as I might be playing, not in the world's greatest arena, not in the NBA finals. It's just like, if I was just balling in the street, am I worried about like playing in the park? I'm not worried about a turnover here or there or who won or, if I took a bad shot. But in the NBA finals, like you're going to care about every single play, every play matters. So I just try to live with that level of focus.
And then you get a lot of information back from your syndicate investors based on how they're reacting. Are you seeing many changes given the macroeconomic climate that they're kind of pulling back? Or in the reverse, because now you're getting multiples come in and pricing getting better, that people are getting a little attracted to these better entry points?
I think it's too soon to tell. I do suspect some people will want to take a pause while they digest what they've already invested, especially if they were loosey goosey, because I'm not the only syndicate they're investing in. But I think there'll be a flight to quality and discipline, and that would be us. So we have been criticized for maybe not doing some of the big crypto deals, and I passed on them or something because I said, I'll totally take a look at this again when you launch the product, but there's no product here. I'm not investing in Filecoin or whatever until there's a product, and Filecoin's a cool idea. I love the idea, but for me, I want to wait till I see the product and I can talk to a couple of customers. Right. And so, but other people want to be more aggressive. And I think AngelList, or was it CoinList or something? One of these, folks, they did Filecoin. I remember I had the Filecoin people on my podcast, or CoinList or whoever.
Probably CoinList, yeah.
And they were having they were doing a SAFT, a future agreement for tokens. And I was
right, simple agreement for future tokens as opposed to a safe, which is a simple agreement for future equity.
Maybe I sound like a dinosaur, but I was like, yeah, I think I want to wait until this is more than a white paper to sell a token that nobody knows the value of. And, maybe that was a losing trade, for much of the last 5 years. I don't know. But, I like to have this discipline. I like to press the advantage I have. I understand startups. I understand products and customers. That's where I understand teams. With crypto and some of these other projects, all I could get was the team.
Right.
And if the team was focused on fundraising, not product, that to me is a red flag. Maybe not like a huge red flag, but it's a mini red flag for me. And I think, even with the regular startups, non-crypto ones, there was just a whole generation who are better at raising money than building products. And, so they could convince investors to give them money at a higher rate than they could convince customers to give them money. That's a major red flag. Now, it's not an insurmountable one. If you can convince a really group of smart venture capitalists to give you money, you're probably going to be able to convince people to use your product. So let's shift the focus here. And this generation, the hardest thing they did was get into an accelerator, Techstars, Launch Accelerator, Y Combinator. That was the toughest. Their seed round was easy. Their seed extension was easy. Their Series A was easy. Series B, people started throwing money at them. Series C, nobody did any diligence and gave them this crazy opportunistic term sheet. And then now what? Now it's they have the traction of a Series A firm, or they did a Series B and they have the traction of a seed firm. They don't have product market fit yet, or they have light product market fit. This is a dangerous place to be, because you got to fill in all of that credit you got in advance. So if somebody says, hey, listen, you're good enough to be in the Olympics and you're not, and the Olympics is 18 months away, you got to get to work. Is there enough time for you to be an Olympic caliber swimmer? I don't know. You might get to the Olympics and you might not even make it to the Olympics. So that's the challenge right now in the market. Yeah, but I do think there'll be a flight towards quality, a flight towards reasonable valuations and traction. We've been valuation sensitive and traction focused since day one. We never changed that. And you asked me earlier, what could I teach people? Process. Have a process, write it down, evaluate your process. If you have people you're working with, compare your process with your friend's process, and then hold each other accountable. So if you were investing in cars or art, hold yourself accountable. Write down why you bet on one and why you didn't bet on the other. There's a book called Super Forecasting, and part of being a good forecaster is writing down why you said no, writing down why you said yes, going back and looking at that decision-making process and asking yourself, well, why did we pass on this investment in Airbnb? Okay, we thought that this was a niche behavior. Okay, what didn't we get? What did we miss? What can we learn from missing on Google, right? There's famously a firm that passed on Google, and maybe it was more Davidow or something. I can't remember the name of the firm, but it was some firm passed on Google and wound up almost killing the firm because it created so much animosity between the partners. I heard you really need to look back on your decisions and say, did I make a good decision? Like poker players do, right? They look back on that decision. Okay, how many outs did I have? Did I study the hand? What was my expected value here? Was there money behind that could have got in if I did hit the nuts? Like, you just got to be thoughtful, and you got to assess how you made decisions and really refine that process. And literally, I was on a call today with my investment team for 2 hours and a call yesterday for 2 hours, looking at our process, refining our process. How many companies are we meeting with? What questions are we asking them? When are we getting back to them? When do we say no? When do we say not yet? How many days? I literally was having a debate today about how many days, if we email somebody like a Calendly link, like to book a meeting, if they don't book a meeting, how many days do we wait before we tell them, hey, do you still want to meet? And it was like, well, we don't want to be annoying and do it in 1 or 2 days. And we don't want to wait a week because that seems too short. So we're like sitting there on a Zoom call going, day 3, day 4, day 5, or day 6 is the number.
What was the
Which
answer?
one should we do? The answer was any of those days would work. So, but when I get to thoughtfulness, like we are so far, just to give people an idea, that we're now debating.
It's good.
If a founder doesn't take a call, well, maybe we're in their spam folder, or maybe they missed it. Maybe it bounced, or maybe they got COVID and now they don't remember and it's in their, when do we respond to them? And then how do we respond to them? Is it the original person? Is it an automated response? That's the level of neuroses and OCD I have about the process. So if you want to get good at something, you better be a fucking maniac, because you're competing against people who are fucking maniacs like me. Like, I'm a maniac about this. Like, I don't want to lose a deal. I don't want to lose a great deal. I don't want to miss a company that emails me. If the company's awkward and they're not ready now, well, maybe when do I follow up with them? And we follow up with almost every company we pass on. Or at least they don't even know we're following up. We're checking to make sure we look for signals that, hey, this company we passed on, how are they doing? I mean, you went through the process with me, and we went through the process with Indiegogo when I had no team. So you actually have a front row seat where I passed on Indiegogo when we met in South by Southwest famously. I was only writing 25K checks at the time. And then look at like now, like I have a process now. I have a team. I'm really trying to think it through. You have a team at Vincent. You're trying to think, are we going to buy these Michael Jordans or this action comic or this, crypto project or this NFT or this painting? Like, you got to have a process. You got to be rigorous. You got to be thoughtful. And you've got to keep going back to that process and saying, what changed? And is this really the best process? Because that's what you have control over, right? You don't have control over the fact that, some maniac in China decides that this is the greatest wine ever and I need to corner the market on this specific vintage. Those weird things happen, or all of a sudden Basquiat becomes something, or, Jonas Wood becomes something, and like everybody's got to own his artwork. Okay, that's not under your control, Or like this Marvel character, Doctor Strange, suddenly becomes like awesome because Benedict Cumberbatch is, cast as that person, and all the Doctor Strange comic books, which cost $1, are now worth $100. Like, who can actually predict that? Well, maybe you could, because you're watching the castings. And the second you saw the casting, you bought all the Doctor Strange you could. Like, I thought about that, if I was like buying comic books, like I would be looking at the fan boards of who they want to see cast next. And just whatever the Reddit maniacs are saying, like I would be just, buying, which characters they are talking about the most.
So you mentioned Google, and then obviously you've invested in like Uber and many other great companies. Is there an industry that you think one of the great next companies is coming from that you're going to invest into?
Well, B2B, SaaS, subscription-based services as a business model is really, really powerful, and founders are very aware of it. So whether it's consumer subscription where people pay for Netflix, Spotify, com.com, et cetera, and they pay for it every year, that's really powerful. Like they did for newspapers or, Disney Plus, Netflix, whatever. But SaaS specifically, businesses paying on a subscription basis is very powerful because it's very affordable and you get a ton of value. And then I would say, industrial stuff hasn't popped yet, but we have an investment in a company called Blockable, which builds homes and factories. And, people saw Uber and Airbnb operating in the real world. And there are other companies that are, Flexport is considered like a company of the future. Stripe is considered like Stripe and Flexport. I think people right now think will be the next big IPOs in the coming years.
As a matter of fact, just the Vault Fund actually has Flexport shares.
Perfect. So if you look at those two as being two of the company, I didn't know that, two of the companies of the future, they are a logistics business to business company and a finance business to business company. These are not consumer companies. What were the last big ones? Airbnb, Uber, and Google and Facebook. So the last, and Tesla, the last really big ones were consumer facing companies. And the next group are not going to be. They're going to
Interesting.
be business to business industrial ones in some cases, right? This doesn't mean that consumer is going away. It just, I think tech is just getting so good and the entrepreneurs are getting so bold that they're tackling logistics, education, insurance. They're going to tackle things that you didn't think they were going to tackle, payments.
Absolutely. You mentioned journalism and media in the beginning as to how you even got into this. And now you're so well known for your podcasts and your shows. How does that influence your deal flow, your decision making, your access, etc.?
It happens to be that talking is my superpower. I talk too much, people say. They told me my whole life. But I love having great conversations and talking. So it's very easy for me to do. I don't think every investor needs to do it or should do it. They should do it if they love it and it works for them. Some people are better writers. Some people are better at going to conferences. Some people are better at doing research and just doing one-on-one meetings. So I don't think there's one path, although a lot of investors have been following my path. And it seems like if you're an investor, you have to have a podcast right now. But podcasts are great for developing relationships. You and I are catching up here. It's an excuse to catch up for half an hour, an hour. And then other people get to be in your orbit. So I have done 1,300 episodes of This Week in Startups, 80 or so episodes of All In. And so you meet a lot of people. I get to have people on as guests who I've invested in already. I get to have people on as guests who I want to invest in. And I learn a lot because I have smart people on. I ask them basic questions and I listen deeply to the answer. So for me, it's like getting an MBA every year. So I probably have like 11 MBAs on my wall just from doing all these meetings. All these podcasts. And a bunch of people get to sit on them and appreciate it. My Lord, it's like amazing. I go skiing or I go to Miami or, to, my kid's school or whatever. And 5 people will ask for a selfie or bring up an episode or ask to be on the pod. It's a great joy for me, if I'm being honest. It's awesome to meet people. I love people. I love meeting people. So it's absolutely fantastic. And anybody I invest in all likelihood, will be on the podcast at some point. And so, although it's not like guaranteed, it's pretty much guaranteed. Like if your company does well, I need to have guests on. So at some point you'll be a guest. So just sit tight. And I think people get that because they see me have people on the pod who we've invested in. I say, hey, I invested in this company. You should know about it. Here's why I invested, and here's an interview with them. And that helps them, right? You've probably experienced that yourself.
Yep. No, that was super helpful. We're coming towards the end of the episode here, but just a couple of last questions. One, what is the, outside of your own content, what do you like to watch, read, or listen to?
Good question. I am, on a purely entertainment basis, absolutely in love with the golden era of television and streaming right now. There's like too many good shows to watch. So my wife and I have, just pick off different shows and, the Disney stuff has been great with my kids. The Obi-Wan series, The Mandalorian, Book of Boba Fett, the Marvel stuff has been great. And then I love audiobooks.
Anyone you would suggest?
Oh my God, it's way too many to suggest, but let's see. I like to be thoughtful about it. I'm looking through what I'm listening to right now. I just listened to Putting the Rabbit in Brian Cox, the actor's book, Putting the Rabbit in the Hat. Was really good because he read it himself. I love that.
Nice.
Let's see. Man, I listen to so many of these books, but they're also average. On Writing by Stephen King as a writer, I think is like one of the best books on writing I've ever read. Born Standing Up by Steve Martin, also incredible. Grinding It Out by Ray Kroc is an extraordinary one. The person who bought McDonald's and made it into the modern day McDonald's. Bird by Bird by Anne Lamott is another writing book that I love. I'm writing my next book. So,
what's that going to be about?
It's going to be about money and wealth. Yeah. So broadly speaking. It's not like how to make money kind of thing, but just about the concept of money.
Great.
And I really enjoyed, there were two books about Netflix, No Rules Rules. And then there was another one by Patty McCord. I can't remember right now, but they were good as like a pairing. I really enjoyed.
She was the people officer. Is that right?
Yeah, she was the chief people officer, Patty McCord, and hers might have been better actually, slightly better. Kent Langone's I Love Capitalism was very good. He was the investor in famously in that Home Depot, I think, and it says really good to go through these. Alchemy by Rory Sutherland was quite nice. He's a really interesting cat. The Ride of a Lifetime with Bob Iger was very solid. Not as good as Michael Ovitz's book, Who is Mike Ovitz? But both of them were really interesting. You could hear a theme of I like biographies.
This is great.
Literally going through my audio. I'm literally scrolling up in my Audible right now. Let's see. Old school, Good to Great was awesome. Skin in the Game by Nassim Taleb and Black Swan are always classics. I've re-listened to some of those. His stuff is great. Michael Lewis's stuff is obviously really good. I've enjoyed all of his. And I enjoyed also Powerhouse, which was like the oral history of CIA. So if you pair that with Michael Ovitz's book and
Wow.
the book by Bob Iger, you get a really good like history of like how Disney became everything.
Mm-hmm.
It was really good. I think that's a good group of books to get people started in the J-Cal collection.
That was 10x more than we usually get, so that was awesome. My last question.
I literally for every book I gave you, I scrolled past at least 10 or 15.
That's good.
Another good one, actually, for what we're talking about is Thinking in Bets by Annie Duke. It might be a little
the
too
poker
basic.
Player.
The poker player, yeah. It might be a little too basic for some people who are into poker, but for people who are venture capitalists who are trying to understand like why is poker and venture capital so aligned, it's because making decisions and putting probabilities on them. So she's a good writer. She's good at teaching people stuff. So I really liked it. And I really recommend it. Another really good one is the Checklist Manifesto. It just teaches you how checklists are really important for discipline, for process, and how checklists help like things like planes stop falling out of the sky and surgery, or stop people from killing people in surgery, and working backwards, the Amazon principles of like writing first and 6-pagers and all that stuff I really enjoyed. So, a Red Notice is very good by Bill Broder. I have like a group of things I like because they're biographies and I find them inspirational, and there's some tactical, and then there are some that are tactical that you can just apply piecemeal what you like. So the Netflix books were the two Netflix books, Patty McCord and the other one. Those were very good because you kind of really start learning about culture and stuff like that. It's very tactical. Checklist Manifesto, very tactical. Good to Great, very tactical. Thinking about it's very tactical. And then there are ones that are inspirational, like Ovitz's, but you can find the tactics within them. And so I find with those two series of books, I can, Stephen King on writing and Born Standing Up by Steve Martin combined with Anne Lamott, Bird by Bird, you kind of get this like tactical plus storytelling of like, the anecdotes. I really like that combination. When I did my book Angel, it was a lot of my anecdotes combined with my philosophy. And so buy Angel or get it at your local library.
Perfect. It's almost like using two sides of your brain. Last question to put you on the spot, and you're going to say this isn't investment advice, and we're going to want to have a specific idea, which
Amazon.
is
Buy stock in Amazon.
that is where I'm headed.
Oh, okay.
Which is what would be one investment, and I ask every guest that you would make today, or that you would suggest to the audience that they look at making, that they can do today that we'll look back 3 years from now that we think that was a good investment, and it could be anything in any alternative investment space.
All right. So I'm still a very large shareholder in Uber, and it's still the company that gave me the most success. I think it's unbelievably undervalued. I'm still very long the company, and to the in a network-based economy, the network effects really affect the winner. So if you look at what's happening with Lyft versus Uber, you're starting to see this sort of bifurcation of like what a network effect can do on either side of the equation. I think that's worth looking at. But putting aside that, um, gosh, I can't give you a specific startup because those would all be private.
But you could do that if you want.
Well, I think,
That is an alt, any private
yeah,
company.
startups are alts, but I very much like startups. I'll just give a name of one, which you can't invest in because they're privates. But as an example, consumer subscription, which we had great success in Calm. Calm's already a $2 billion company. If you could buy shares in it, I'd certainly tell people to take a look at it. That would be a later stage investment. But we have an investment in a company called Fitbod as but one example of these consumer subscriptions, and it's a fitness app. But it's so well done and it's so singularly focused that you don't need a lot of people to build these singularly focused, Netflix of or Spotify of meditation, Netflix or Spotify of working out to really become, highly profitable or high growth or very stable businesses because they're subscription based. So I think looking at subscription based consumer products, Musician is another one we're in. Steezy teaches dance. Tone Based teaches classical music. So that group, I went on a little research project and we found a couple in each category and we really went to town on those. So Calm for meditation, Fitbod for working out, Steezy for dance, Musician for popular music and instruments, Tone Based for specifically doing classical music, Fluent Forever for learning languages, all these kind of subscription things that make you better. I didn't invest in Masterclass. I thought that's a really interesting company. I wish I had. I passed on the first Series A based on valuation. Was one of those times it was a miss where valuation was too high. I didn't follow up. I should have followed up because I thought it was going to be a one-trick pony. Like the founder knew Dustin Hoffman through his family. Dustin Hoffman did it. And I was like, I discounted that when I should have actually not discounted it. I should have taken that as, he took advantage of an opportunity to build this thing. And then he did, then he got everybody else because he had Dustin Hoffman. I thought, well, like how many times can you do that? Like, does your dad know everybody? And it turned out maybe he didn't need to know everybody because he got Dustin Hoffman. And, like Dustin Hoffman doing a class on acting and, whatever is just extraordinary. So that's a stupid miss again. But, you're defined, you don't have to hit everything. And you typically get defined by a small set of winners in your career, especially in the alt and startup investing space. So process.
Yeah,
It's a
amazing
great discussion. I really like thinking about my betting strategy. And so I appreciate you taking the time.
Absolutely. Thank you for covering all of this. It's been a great roller coaster of conversation. We covered so many topics. Taurus.
I don't know how long you go typically, but you can make it a
No.
if you want.
This is long for us. I mean, you had some really good sound bites. Taurus season is over. The great repricing is in. Valuations are cut in half. What sounded like a 20 in the early stages now is 6 to 12. You got in because you like the things like the 16th Tesla or, the model signature number one. You target your Goldilocks window, not too hot, not too cold. You love equity crowdfunding. You love the transparency. You love getting put on the big stage. And I can definitely say you use the word process the most of any word on this episode, which is follow the process. If you need some help, get Checklist Manifesto because that's a book you love. Thank you, Jason, for being on the show. We look forward to having you back.
I'm Jason on Twitter and Jason on Instagram. If you follow me in those places, I will probably follow you back.
Goodbye.
All right. Awesome. That worked out well. What a great conversation. Let's do it in a year.